Buenas tardes y bienvenidos todos a su cita semanal con los principios de las finanzas personales responsables y de la inversión consciente. Bienvenidos todos a Value School. Empezamos el mes y lo empezamos un poco tarde el mes de diciembre pues por las fiestas. Ya saben que en España y en muchas otras partes, pero en Madrid incluso en particular, este es un mes con muchos puentes, muchos festivos y ya ven, hemos empezado la programación del mes casi a mitad de mes. Además, por ser un mes, como digo, especial, con tanta fiesta navideña que va a venir dentro de poco, tampoco tendremos tantos actos, tendremos nada más que 3 o a lo sumo 4. Creo que está cerrada prácticamente ya la programación con 3, pero bueno, quizá podamos tener algún invitado de última hora sorpresa, ya veremos. El primero de ellos es un invitado que ya vino, estaba hablando con él antes de empezar la retransmisión, hace casi un año. Es Wim Antoons y vino a presentarnos sus ideas acerca del market timing. Hoy le tenemos de nuevo, con lo cual la conferencia, eso significa que la conferencia será en inglés y yo cambiaré ahora mismo al inglés en cuanto haga esta presentación. Le tenemos para presentarnos un paper, un trabajo académico que acaba de publicar y que ha tenido a bien, porque ha podido venir a Madrid a presentarlo con todos nosotros. Así que la conferencia será igual que siempre, su presentación, que durará unos 30 minutos, y luego un turno de preguntas de audiencia presencial y de audiencia que nos sigue por redes sociales. Como saben, los vídeos de Value School siempre se suben después a YouTube, los subiremos seguramente la semana que viene. Y bueno, pues pueden seguirnos por redes sociales, por Twitter, por YouTube, como digo. Vayan por el blog también si quieren a ver lo que estamos publicando este mes, que sigue un poquito en continuación con la labor que hicimos el mes pasado del Out of the Triangle, de tocar esos temas que se nos quedaron un poquito en el tintero. Y bien, sin más, voy a cambiar ya a inglés y vamos a presentar al ponente. So, Wim Antoons is Head of Asset Management at Bank Nagelmackers in Brussels. He's from Belgium, right? But he will speak English tonight. And he is a member of the Brandeis Institute Advisory Board. At Nagelmackers, he oversees the investment process for the private banking and fund of funds business. He has established the firm's value investment philosophy and its open architecture fund platform. He is also co-manager of the Nagelmackers Fund and manager of the Nagelmackers Privilege Fund. As I said before, he will speak for about 30 minutes, after which time we will open the floor for questions from the live audience and the audience from their homes. With that, I leave you with Wim Antoons, and his presentation tonight is U.S. Equities, Looking Back and Forward. Thank you very much, Wim.
Thank you. Thank you. Good evening, all of you. Thank you for hosting me. So tonight we are going to talk a little bit about the valuation of the US markets, and as you might be aware, there is some volatility going on, so it might be a good time to talk about this. And you can download the paper for free on the Brandeis Institute, so have a look at, it will be distributed I guess also afterwards, but have a look if you want to read the paper. It's not too long, not too difficult to read, so you can have it there. So when you want to know the valuation of the market, there are different factors you can use to do so. And the factors we have used here today is, we will look at some others too, but the main factor is the CAPE ratio, which has been developed by Robert Shiller. So he won the Nobel Prize 3 years ago for all the work he has done in finance. And the advantage of this ratio, the CAPE ratio, is that it's better predicted than the price-earnings ratio. Why? Because it's smoothened out business cycles. So when you are in a period when there is depression like in 2008, it goes very bad. It's smoothing it out because it's looking at a longer period, over 10 years and not over 1 year. And the second thing, so the price will be adjusted by the inflation. So all the earnings of the companies will be adjusted, and that's a better ratio. Now, if you look at what is the best factor to make a prediction about the stock markets, then this is a kind of research that I like. If you, for example, look at earnings growth and GDP growth, in every investment company, people are looking at these figures. And it turns out over the longer period, it's 26 to 2011, it doesn't explain anything about the valuation or the variance in the stock market. So these factors, you can look at it, everybody's talking about it, but it doesn't work. You would have done a better job just by looking out of the window, because it turns out that rainfall explains about 6% of the variance. Of course, everybody knows this is not working, but there are factors that are working much better, but rainfall is even better than earnings growth and GDP growth. The factors that were best are price earnings. You see price earnings 1 year, it has about an explanation of 38% of the variance, and the best we have found is the kappa ratio, and that's the reason why we also in this paper are going to talk about the kappa ratio. It explains about 43% of the variance. Now Robert Shiller has done a wonderful job because he has computed the kappa ratio over a very long period. He started in 1881, and so you can download it also free from his website. So you can see what the ratio has done over the years. Here is still June 2018. You can see the red line is the average, is about 17, and then you can see the outliers in the market. So what you see that we have had a number of periods, the red dots, where it was very high, and of course we have had the opposite, some periods like 82, and here, beginning of the 20s, when the market was dirty cheap and nobody was buying. Now, if you look at the returns, what you might expect in these periods, let's look at the dots, then you can see that there is really a difference. Here we look at historical returns. So we are at the dot, what have we seen? When the kappa ratio was very high, like in September 29, just the beginning of the crash, and we have seen it also at the end of the internet crisis, the dot-com bubble, what we have seen is that the previous returns were very high. Look at different periods, 1 year, 3 years, 5 years, and even 10 years. You have historically very high returns. And of course, you have the opposite when the market is very cheap. If you look at December 20, June 32, or July 82, you were at a very low kappa ratio, and what you can see, nobody was investing because even the 1, the 3, the 5, and the 10-year figures looked very bad. So there is something to say about historical returns. Now, let's look at what might be expected, and then you see, of course, the opposite. What you can see in September 29, kappa was very high. The future returns on all these periods were also very low, 1, 3, 5, and 10 years. The same happened in December 99. This is more of a history for us. But as you can see, future returns were not as devastating as here, but are very low. And here, not surprisingly, when you buy when the market is cheap, the future returns are very good. Now, it's very strange, but I don't want to make a forecast on the market. So the presentation is not about to say the market in 6 months is going to be this or there. We're going to talk about long-term returns. That's very good to remember. Now, there is most of the research, if you talk about whatever, value investing, if you talk about this kind of research, is always done in the US because they have a very long history of figures. They have all the figures from 1926, and as you can see, sometimes they go even further back. Here this is a research in different countries, and we see more or less the same phenomenon happening. As the kappa ratio starts to go up, you see that the subsequent 10 years return go down. And you have it, here it's something you can see better. We have done it for different countries in this piece of research. What you can say in all countries, it's the same. Once kappa is low, you can see that the returns, subsequent returns are very high. The higher it gets, the lower the subsequent returns are. So it's not only a phenomenon we see in the US, we also see it in other developed countries, that there is a relationship between the valuation of the market and what you can expect in the future. Now, there are a number of reasons, and you read them also in the newspapers, why the American market is quite expensive. And there are a number of reasons, like, for example, some people say there is a structural change in EPS growth, earnings per shares. And as you will see later in the presentation, it is quite high, so it's very sound. So there is a good reason why the stock market is more expensive than it used to be in the past. Some people talk about demographics, aging of people, and they say people will need more medical care, and this is good for stock prices. But some people say the opposite, and they say as people are aging, they're going to spend less. So there is an argument they could use for both. We're in a stage of very low interest rate level. We see in the States they are starting to go up. The Federal Reserve is increased rates level. But if you look from a historic point of view, it's still very low. So it makes sense that equity risk premium is higher and that the stock market is a little bit overvalued. Some people talk about volatility in GDP. Volatility also in the stock market has been very low. So it could be a reason why the stock market is more expensive. We have had the tax reform of President Trump, which was very good for US companies. So there are a number of reasons why you can say, hey, these stock markets may be a little bit more expensive. But there are debates going on. Some people say it is the right reason. Some people say it isn't. So it is a discussion. Anyway, if you look at EPS growth, you can see it's at a very high level. And we go back also on the 81, you can see it's at a very high level. But not to say we were at this previous level also, and then it came down. So I'm not predicting tomorrow it's going to come down. But anyway, we have seen these levels before. And as always, we will get a recession within a couple of years, I don't know when, and then these earnings per share level will go down. So there's not a trend. I don't believe that is structural going to be at a level of about 10% per annum. As you can see, there is no correlation between earnings growth in the past and in the future. You see this line is more or less flat. So also if you look at the analysis, it doesn't explain. So previous returns don't explain future EPS growth. So I don't believe that saying that EPS growth will be forever at a high level, I don't think it's correct. Some people talk about the Fed model. It's the Federal Reserve low interest rates. They say because the interest rates are now very low, about 3%. So it should explain that the capital adjusted earnings yield should be about 3%. Now, some people don't know a history because in the 50s the bond yield was much lower. It was about 2%. And then we had an earnings yield of 16. So you cannot explain the high valuation just by looking at the low interest rate level that we have today. Because we have seen periods in the past where it was even lower and the market was not that expensive. This is some regression analysis that we have done on different periods, 3, 5, 10 years. So also the period 1881, 2018. What you can see is there is a kind of relationship. As we have seen, the higher the KP ratio, the higher it becomes. So the previous returns, these historical returns, were higher in the build-up phase. It's a pleasant period. Also, in 5 years' time, you can see that here's historical returns are higher the more you go to a higher KP ratio, and the same on a 10-year period. Now, interesting is we also looked at the short-term period, and we tried to measure, can we make a prediction about the next year for the stock market? And it turns out that if you look at this graph, that you cannot predict the short term. If you have a low KP ratio, you have much of the dots are just above the line, which means that the expected return is very high. Some dots are under the line. But as you can see, there is no main difference between a KP ratio of 10 and 20 and even 35 or 40, because you can see you have always dots above and under the line. The reason for that is momentum comes into play. A momentum is a phenomenon which has been described, is that stellar returns, good returns, attract more investors, and people just invest because the stock market goes up. Until there is some kind of panic, it turns out, and then momentum is dead. And that explains why in the short term, even a market which is overvalued can become more overvalued. If you remember in 1996, Alan Greenspan said the stock market is overvalued, and it continued to go up for another 4 years. So it's quite difficult to predict in the short term what the market will do. This is a research from a Spanish professor, Javier Estrada. He's teaching courses at University of Barcelona. And he did more or less same piece of research. He looked at 3 valuation matrices. He looked at the KP ratio, price to debt, and price to earnings. And he was trying to measure what is the best, a buy and hold strategy, just doing nothing, or market timing, try to time the market based on these 3 parameters. His period was quite long. He started in 1899 to 2014. And his conclusion was more or less the same. In the long run, you can add some value by looking at these valuation parameters. But in the short term, you cannot predict what the stock market is doing. So you can also download this for free on the website. So it's also a lovely piece of research. If you look at forecasted returns, you can see that this is the opposite as we have seen, of course, in the other pictures I show you. the more expensive the market becomes, the lower the future returns are. And you can see here you have a lot of dots above the line, but once you are on a level, the level today is about 32 when we made the study. At the level of 32, you can see that the forecasted 5-year returns are around 0%. So not a very good outlook for the market. Here I try to focus just on the levels which are at KPI of 32 and higher. As we have seen, there are not so many observations. We have only in 3% of the observations of the stock market was more expensive than today. So it's good to remember we are talking about a period of 140 years. So only 3% of the monthly observations were more expensive. And if you see nearly all the dots from this level on a 5-year are negative. The only thing you can say is that the regression analyses show that it doesn't explain very good. The lower the figure is, the weaker the correlation. It's all explained by this dot. This dot was September 29 when the 5-year return was minus 22. That's very low. If you remove this dot, then you can see that the explanation goes to 60%, which is very, very high in statistical terms. So we're quite sure that we can say over 5 years' time, if we look back, the performance of the stock market will be around 0 for the US. Here we divide it in buckets. It makes it a little bit more easy to understand. So the different buckets of the cap ratio going from very low to very high. Remember that today we are here. And then you can see that there is a kind of correlation. We looked at forecasted returns on 1, 3, 5, and 10 years. And as you might see, it goes down. It's not a perfect correlation because you can see that here we expect lower returns than, for example, here, where the stock market here is more expensive. So it's not a perfect correlation. But anyway, there is only one bucket, and that's here, where we see that the returns on 3 and 5 years have been negative, of course, in the future. So it is to mention that at a KPI of 32, we need to be cautious about what we expect for the US market. We have looked at a number of other parameters. This is quite an interesting one, is the Hussman PE. And I will try to explain what it does. It looks at 3 factors. And they have a red line when these 3 factors are fulfilled. The first factor is that the S&P 500 is at a 5-year all-time high. The 5-year period high. The second, it tries to measure the dispersion between the stocks that are at the lowest point and the stocks that are at the highest point. And if you have a big dispersion in the market, it seems that something is wrong. And we have seen the same happening in 1999. So they measure 2 things. First, the number of lows are higher than 4% of all the equities that are quoted on the market. And the second one, it's higher than 1.5 times the stocks that reach the highest level. And then they have this red line, and what you see, it's quite a perfect prediction of when the stock market is overvalued. And not surprisingly, you don't see it, but here is another line, and this was just a couple of weeks before the article was released. So again, we have a signal that the stock market is overvalued. It can be explained by, in the US, you see a lot of people chasing these days what we call trackers. Passive investing. Makes sense because it's a very cheap way to invest your money, but the problem of passive investing is that everybody's chasing the same stocks. You must have heard about the FANG stocks, Facebook, Apple, Netflix, Google. Everybody is chasing the same stocks, so the valuation of these stocks goes always higher and higher, and it means that always a smaller number of stocks goes up. It's not driven by the entire market. A good example, but nobody is talking about this stocks, it's from the Felder report, is McDonald's, Caterpillar, Boeing, and 3M. It's 4 famous US companies. And if you look at the enterprise value, which is more or less the market capitalization versus revenues, you can see that this has risen enormously over the last couple of months. And it is all driven by inflows in trackers, passive investments. It becomes more surprisingly if you look at the next slide, because there you see the revenue growth. So what you see is that the market cap has exploded over the last year, but the figures of these companies have been worsening. And this is really not normal. So if you, from a fundamental point of view, look at a company, you're never going to invest in such a company. And these people invest in the company just because it's part of an index. And that's, in our opinion, a wrong way of investing. So a large number of people chasing the same stocks, and that's what drives the difference between the lows and the highs in the market. Another way to look at the valuation of the market is what we call Tobin's Q. It has been developed by James Tobin, who's a professor at Yale University. And he was trying to measure what is the market value versus the replacement cost. So suppose you need to build a new factory. What does it cost to replace this factory? Pure on the books. And yeah, you should expect a level of about 1. But now you can see, it has been higher before here, but now you can see that the market is again about 17% overvalued just based on this factor. So it's quite high for the moment. So the presentation has been made just to make you aware that we should be cautious about what we expect in the market environment, especially for global investors. As you might be aware, the Cobas funds are global funds and they invest worldwide where they find opportunities. Now, if you look at the index, the MSCI World Index, it's today composed 61-62% out of US companies. And there is a historical reason because these indices have a tendency to always give a higher weight to the companies that rise most. And that's the reason why it is now 60% US, because the US market has done much better over the last 10 years than other regions. We have seen the same happening in Japan in the 80s, when Japan was in an incredible boom market. At a certain point of time, Japan was 45% of the MSCI World Index, and then it came all down. And this is the reason why the weight is so high. So we don't think it makes sense to mirror just your investments at this index, but I think from a fundamental point of view, it's better to be diversified also in other regions in the world, also in Europe, in emerging markets, Japan, and so on. So going forward, there is more volatility in the market. I was quite lucky with the publication date because I said I didn't want to predict the market. The fact is going down now. It's not a prediction I've made. But anyway, what you should do in current market environment is just rely on fundamental research. There are great companies out there. And you should be aware that investing in overvalued, some of them technology companies, is not a good play today, but you should chase some kind of contrarian value investment strategies. If you invest in the stock market, it's always a long-term play. You cannot say what the market is going to do the next year. So I'm sure there will be more volatility going forward because we haven't seen volatility over the last 10 years. So going forward, there will be more volatility. In the last paper I presented, I talked about market timing. Just can you beat the market by go to cash and try to avoid the volatility in the market, because that's what some people do in current market environment. You can read the paper, it doesn't work, because if you go to cash, you will be late coming back into the market. So it's a very bad advice to say we are going to put our money not at work for the moment because there is more volatility. Just stay invested, but chase the good stocks. And then avoid overcrowded trades. As I said, the FANG stocks are a beautiful example. They are great companies, but they are massively overvalued. You should look at valuation when you invest and avoid these trades, because these companies, as we have seen also in 2000, will come down because they are overvalued. So I'm open to questions. Please shoot, and I hope I can help you.
Thank you. Thank you very much.
Welcome.
I will now come back on stage with Wim.
Yep.
Let me, yes. Thank you. Thank you for a good presentation. And everybody at home and also here live with us at Value School, have your questions ready. I'm going to turn on my phone so that my colleagues in the back can start sending me the questions from people at home. You're welcome to ask in Spanish. I will translate quite happily, or in English. So far away, who would like to be the first to ask a question in the house? Raise your hand. Gentleman here in the second row.
Thank you. Could you be more specify more when you say invest in contrarian value? To be more specific, what you mean exactly with that?
Yeah, I think we've had a period where it was very easy to make money, as I show with the trackers. No matter what you were buying, the stock market was going up. I believe in what Cobas is doing and other managers is you should look at balance sheets to see what you are buying. And if you can buy a company which is worth 100 euros and you can buy it for 70 or 60 euros, then you make a good deal. And that's what I mean by fundamental research. Most of these companies are out of favor for no reason, and that's why it is contrarian. But you should try to chase these stocks because in the long run it has proven to work. There is a value premium. And definitely when the market starts to be more volatile like now, the period of easy money is gone. So it makes sense to look at balance sheets and to go for a fundamental research.
Very good. Wim, next week we're having an event with 3 other money managers, fund managers, all value investors. And in Spain, value investing has not done very well this year. And we want to discuss with them why that could have been so, and advice for people who have their money, their savings invested in this type of fund. And because I know market timing is one of your topics of research, I guess that those customers who are becoming liquid, leaving their funds at this point, waiting for a better moment to come in, are trying to time the market. Yeah. And you say that's a losing gambit.
Yeah, it is, yeah.
Why is that?
It is a fact that, first of all, people don't take into account that you have a lot of taxes and transaction costs. So if you trade, you sell out, you're going to pay taxes, transaction costs. You need to pay again when you come into the market. But the most important reason why you lose money is you're not going to come back when the market is at its lowest point. Remember the crash of 2008? I've seen so many people selling out. Then we arrive in March 2009. It was so dirty cheap. And when you were talking to people, everybody was saying, I don't invest into the stock market. And then it starts to go up. And then you hear these stories from it's the bull market rally in a bear market. And they don't invest. And I have some people coming back in 2012. The second thing is when the market rebounds, normally the biggest gains are to be made just after the correction. So that's the reason why you should stay invested. I know it's very difficult to do so. There's a lot of research in behavioral finance that explains that. It's very difficult, but it's the best way to do so, yeah.
Why is it difficult? What's working in here
brain, yeah,
that makes it... Do you agree that we are worst enemies when it comes to investing?
Yeah, definitely, yeah. It's, there are so many great books and they're great to read because it's fun to read them. And they explain why people always do the opposite as they should do. So most of the people, they panic, they sell out, even they know you might explain them from a logical point of view that it's better to stay invested. They're just going to sell out and they won't come back, and they only come back when everybody's coming to the market. And we have seen it in history all the time. There are wonderful pieces of research on it. When everybody is rosy and everybody says you must invest, it's probably the worst time to invest. And when there is blood on the streets and everybody say, I don't go to the stock market, it's the best time to invest. But it's very difficult to implement because it goes against your feeling, your emotions.
What would you say to someone who, for instance, keeps some of his savings in an expensive fund, let's say a 2% commission, and then he's got some passive indexing funds on the side, and the expensive fund is not doing very well, so I'm going to transfer some of my money to the passive investing funds, which are much cheaper, and wait for a better moment to get back in the high-speed train. Would that be a wise move?
Well,
in the meantime, I'm saving money. That would be the rationale.
That's the rationale behind it. And passive funds have their merit. As you say, they are very cheap. The problem is that people don't buy a stock because they like the stock. They buy the stock just because it's part of an index. And I think that's the wrong reason to buy a stock. You should buy a stock because you believe in a company, not because it is in an index. The second thing, we have had a period where active management was underperforming a lot, just because people put all their money in passive funds. We have seen these periods in the past that passive is leading. We have seen periods where active is leading. So active investment will come back. It's a matter of time. And then there will be a turnaround that people will go again to active management. So, yeah.
Mm-hmm. Any other questions from the room? First row, please.
Yes, thank you for the presentation.
Thank you.
We've seen in the last decade that not only the equity market has become expensive, but I think it started with fixed income, then moved to real estate, infrastructure. 10 years ago, you could buy a office building in London, 20 times PE. You have to pay now 50 years of earnings. So, and given that, the economic backdrop seems to be slowing down, when do you think the valuations of all these assets, real assets, infrastructures, also the equity market, will come back to what you believe is a normal? 10 times CAPE ratio? I don't know.
That's very difficult to answer, because you touch on a very good subject. 2018 is the most difficult year to invest since 1972. And the reason is there is no place to hide in the market. So you cannot hide in fixed income. Fixed income has yielded 0 this year. The same for cash, doesn't give you any money. The same for equity markets. All the markets are down minus 10%. Only US is up, but it's also correcting for the moment. Real estate is expensive. So where are you going to hide? There is no place to hide for the moment. And that's the reason why most of the funds have a negative performance so far. When will it come back? It will take time. The only positive thing is we see some markets that are not still overvalued. Then we're talking about the regions like emerging markets are cheap but volatile. The same with emerging markets debt. You can expect a return of 6% over the next 5 to 10 years. European equities, definitely. And then value has underperformed now for like 10 years. So there are very good value opportunities out there. But the rest of the market is very expensive. I agree with you, yeah.
Wim, there's another question that comes from Twitter. The Munger Games is asking, what's the stock with the highest valuation that you've ever had? And why did you invest in the company?
Oh. I don't invest in stocks myself, I invest in funds. Mm-hmm. But I see some, but we don't invest into these funds. I've seen some funds investing like in stocks with a price-earnings ratio of 400 or 500. Then I say, gee, there's nothing to do with investing, this is more speculating. So I talked about the FANG stocks, and now they're in the bear market. They are down 22-25%, so they have come down, but they were massively overvalued, and these are kind of PEs that you saw in some of these stocks. But I don't invest in that because I don't believe in just momentum and chasing a stock because it goes up. Mm-hmm. So. Mm-hmm.
Mm-hmm. Good. Any other questions in the room? There is a few more questions. Which industries are offering the most attractive margins of safety at the moment?
Oh, you have to name two. Automotive is very cheap. There's been a lot of problems lately with the development of electric cars. They need to do something about it. So there are good opportunities out there. The same, and I know you're also on the covers on it, on shipping. It is so cheap. It's at the lowest point in 25 years. So these are two sectors where definitely you can make money. Also in commodity-related stocks, you see gold miners that are so cheap. So there are good opportunities out there, but you need to be careful with the selection. But definitely, there is money to be made.
And then in order to, again, to educate those viewers who are thinking about investing, what is the reasonable length of time that you would suggest anybody who's thinking, in becoming invested should leave their money for at least how many years?
Yeah, 5 to 7 years.
5 to 7 years.
Definitely,
So
yeah.
trust your manager for that period of
Yeah,
time.
you should look over a full market cycle. It doesn't make... It is, of course, pleasant. You invest your money after 6 months, you're up 10%, and people start to trade to something else. It is pleasant, but it's nothing to see. There's nothing to do with investing. If you invest, you need time, and periods like 2008 teach us that it was a very difficult market, went down 40%, but you recovered it in 2011, 2012, and since then the market went up. So it always comes back, but it takes time. So yeah, 5 to 7 years definitely.
Mm-hmm. Mm-hmm. Any other questions? I have one more for you. Oh, well, there's one in the back. Thank you, Vero.
Sorry. I didn't know so much about the cap valuation, and why do you think it is not so famous than could be the PE or another ratio?
Yeah, it is less used. It is more used to make a forecast about the market. That's true. But for the rest, it's not commonly used. But anyway, it's the best factor that we have found to try to make a forecast on 3 and 5 years returns. So that's the reason why we have used it. But it's not as popular as some of the other factors. Also in the beginning, when the cap is not that old, if you talk about price book, price earnings, price free cash flow, these are measures that people use already for 30, 40 years. The cap is not so old, so I think that's more related to that too.
And there is a time where the cap was wrong?
Well, as we have seen, if you look at the outliners, it gives you quite good signal. If your average level, the average level is about 17. If you're at an average level, it's quite difficult to make a prediction. Prediction is an average also. But if you're at very high level like we are today, you can fairly say that over the next 3 to 5 years it will be difficult to make money. If the market is very cheap, like in '82, you can say we will make money over the next 5 years. So it works best in its prediction when you're at a low or very high point.
At an extreme point.
Yeah.
Thanks.
You use the word forecasting, and I always have, there's this question in my mind. I think I read a quote somewhere that someone would say, I don't trust predictions, especially about the future.
It's from Niels Bohr, it's a Danish physicist. Yeah.
Right. So, and yet, these ratios, this research that is being conducted is, the main purpose is to help us forecast the performance of the market. So isn't there a contradiction? And also, my second question would be, where in the toolbox of the individual investor, where is the place for this kind of research? Should we rely solely or mostly on it, or is it just to confirm our initial analysis?
I think it's always important to have a diversified portfolio, and that's what I mentioned in the presentation. If you try to invest worldwide and you mirror your portfolio to the MSCI World Index, you have about 60% US. That's way too high. So I believe in diversification, and I don't, as I said, I don't try to predict the market, definitely not in the short term. In the long run, there is something to say. But if you build a portfolio, do you need US stocks? Of course, you have great US companies, as you have Japanese companies, European companies. So it deserves a place in every portfolio, but not too high. You know, this is not representing the world anymore if you invest into the MSCI World Index. So and that is what I try to give you as a message. It is not dirty cheap. Should it be dirty cheap, then you can say, okay, I try to mirror the index, but now it's way too high. So you can lower the weight and have a global diversified portfolio, which will give you a very decent return. Yeah.
Mm-hmm. Any other questions? No? Yes. There's we've had other managers here at Value School, and lately There has been, some of them have mentioned passive investing and the tremendous popularity, even in Spain, which is something new. There wasn't much. It wasn't easy to buy these funds until the last couple of years. So where do you see active management? Where's the advantage in the big picture?
The advantage for me is definitely in equity side. Equity side, you can do it. On fixed income, if you talk about these satellites like emerging debt, high yield, I think it makes sense to have an active manager. Govies, corporates, it's very difficult to beat the market, so the fees are also too high. So I think in the equity side, it does make sense. And when you want to be comfortable about what you're buying, it does make sense to have an active manager who does the fundamental research for you, and you pay for that. The good thing about the trackers is that the fees of the active management have come down a lot. So a couple of years ago, they were very high. So under pressure of the market, they have come down, which is a good thing. But anyway, it's normal that you pay a manager for the fundamental research he's doing. So I believe in it in the equity side, definitely. Yeah.
Mm-hmm, mm-hmm. Okay. There is one more question here. Which investors influenced you the most? And can you recommend any books? We always ask our guests for book recommendations.
I've read 77 books until now, so
77 books.
77, I count them. Yeah,
But just one or two.
Yeah, no. I can't name them all. So. No, of course, the book of Benjamin Graham.
The Intelligent Investor.
The Intelligent Investor is Warren Buffett said the best book ever written about investment. It is a very old book, but it's a very good book. And also, like James Montier, he's explaining value investing, asset allocation in a very comprehensive way with a lot of research. It's fun to read James Montier. Just to name two writers, they are very good to read, definitely.
And as far as investors that you maybe model or that serve as inspirations for your work, maybe Warren Buffett? I don't know.
Yeah,
Warren
Buffett definitely. I think he inspired a lot of people. Warren Buffett, John Templeton.
John Templeton.
Yeah, I think it was a great investor, and you have some people that try to follow him. And then you have here in Madrid. Not saying because I'm here, but you have a whole community of. It's like a breed of value managers which are popping up like pop-up stores. So. You have a very good community of managers here, so yeah, definitely. Mm-hmm. And you also in the Nordics, I've had some good managers. So,
mm-hmm.
Yeah.
All right. I have one more question. Well, I have several other questions. Whoa, there is one in the first room, in the first row. I'll get back to my question when we get the gentleman's.
Yes, taking the opportunity to ask a little bit more. On the study, have you identified the event that moved the CAPE ratio from peak to trough? And if you can extrapolate or you can identify the specific kind of events moving the valuation from high to low or to trough, and if that can happen soon?
There are always events, but that's what I once read in a book is there is always an explanation why the stock market should go up, and there is also an explanation why it should go down. So people always find an explanation, but at the end of the day, Benjamin Graham once said, "What will the stock market do?" And he said, "It will be volatile. It will move going forward." So in the beginning of the year, you always ask predictions, and so from next week on the newspaper, you can write all the prediction of the big houses, and they say the S&P will do this, and 10% and 12% and minus. So, and at the end of the year, when you're going to look at these predictions, they are horribly wrong. So one of two is on it, and the rest is horribly wrong. So it's very difficult to make a forecast what the stock market will do. And that's why I also say in my presentation, I don't want to forecast because you simply cannot do it. So that's a very difficult task to do.
Okay, and another one to follow up.
Yeah.
Do you think, we've seen that the stock market is quite overvalued in your view. Do you think that overvaluation explains the movement of money to real estate, private equity, infrastructure, paying multiples, crazy multiples?
Yeah, I think it's a low interest rate environment, definitely. The overvaluation, partly, but there are a lot of pension funds, etc. They're screaming for yield. They want to have yield. You don't have yield on govies anymore. If you look at what you can have on high yield, it's very, very low. The same for corporate bonds. So they are looking for yield, and they go to real estate. They go to the asset classes you just mentioned. The problem is that so much money came in, and all these asset classes are expensive. But it's all driven by a lot of these models must make 6 to 7% to fulfill the liabilities, and the problem is they don't have these interest rate levels anymore. So it becomes very, very difficult. Yeah.
You mentioned in your talk that there's a recession coming.
Well, there will be one. I don't know when.
One.
I don't say there is a recession coming. It can be 2024. I don't make a forecast.
All right. Okay.
So don't misunderstand me.
Sorry.
Don't
maybe my
misunderstand me.
misunderstanding.
Yeah,
so there is no. You don't. Well.
No,
okay.
I
That was my
don't-
question. I was going to ask you. Obviously, I misinterpreted you. Is there any other question? Well, my point was, do you pay attention to the economic news, politics, etc., and in order to understand, what the market is doing and how to maybe, get ahead of the most likely upcoming events?
Yeah. Every asset manager is looking at macroeconomic stuff, and I think it does make sense to try to explain also to clients what happens in the market. But as we have seen, it doesn't predict the market, so it's quite difficult to say GDP growth is doing that, and we think the market is going to do that. But anyway, it makes sense to be aware of where you are in terms of the cycle, and you also know that there is a kind of, if you're in a period when everything is rosy, it's good to invest in equities. When you're in a recession, you must be careful. So it's good to have this kind of information. So we also have a macroeconomic committee where we discuss these figures, definitely. Yeah.
Mm-hmm, mm-hmm. I don't know if you are you familiar with the Austrian School of Economics? And their theory of the business cycle a little bit, but maybe it's not something that you're using in your day-to-day activity to interpret the macroeconomics. Okay, right. Thank you. Any other questions from the room or from people at home? No? Well, then we'll call it an evening. But before we do that, I would like to make you a present. Wim, we publish books. And this is our gift to you for having come to us, to Value School, to have this wonderful presentation. That's Francisco García Paramés' book in English, Investing for the Long Term. It's also in French. And we hope you like it. I'm not going to say that you're going to read it on your way back, because it's a bit... it will probably
I have 2 hours in the airplane. So.
It may take you a couple of good hours, maybe, at least. But we hope you enjoy it. Thank you very much for coming again after almost a year of your first visit. And of course, our door is always open to you. Thank you very much, Wim Antoons.
Thank you. You're welcome.
Y para todos ustedes, pues muchísimas gracias por estar aquí una vez más, una semana más. La semana que viene también vayan a la página web si no se han inscrito ya. Tienen todas las actividades en nuestro calendario de eventos y tenemos por ahora, como he dicho antes, 2 conferencias más. Les veo aquí la semana que viene. Un saludo y feliz semana.
Okay.
Short,
Thank you.
sweet. Was an hour.